This segment is going to look at writing off of an account under the allowance method. At some point or another, a company will determine when a customer's account is truly uncollectible. Under the allowance method, when an account is determined to be uncollectible, the account is written off against the allowance for doubtful accounts. We do not write off an account against bad debt expense because the bad debt expense is recorded each year at the end of each accounting period using the bad debt expense allowance method estimate. So on December 27th, ABC determines that a particular customer, Martin's $300 account is uncollectible. All we need to do is write that account off of the general ledger, clear it out of any account that has an amount related to this bad debt. The two accounts that have an amount related to Martin's bad debt are accounts receivable, and so we will credit that account to take Martin's account out of accounts receivable, and we will debit the allowance for doubtful accounts, decreasing the account by the amount of the bad debt that is no longer in our accounts receivable. This journal entry decreases the allowance account and decreases accounts receivable. If we subsequently receive a collection on an account that had been previously written off, we need to make two journal entries. The first journal entry is to reverse the initial write-off, and then the second entry will be to record the cash collection. So if we receive a collection on this account that we had previously written off, we would first reverse the entry by putting the receivable back into accounts receivable, increasing it with a debit, and putting it back into the allowance for doubtful accounts by crediting that account, increasing both those accounts again. Then we would receive the cash receipt, debit cash, and credit the receivables to record the payment from the customer.